10 minutes. My name is David. At 24, I was let go of my corporate job. By 34, I was financially free with an 8-figure net worth. And during that time of 10 years, I bought 10 properties, one property a year for 10 years. And this is exactly how I did it. First, I used my corporate earnings. That was the biggest thing. So I started a small business in Canada. And if you start a small business in Canada, you're taxed at 12.2%. So if you make $100,000, you're taxed at 12%. You have $88,000 left over. What do you do with that? There's two things that I did consistently every year. At the end of the year, I knew what my cash flow was. And what I did was I took that cash flow and I reinvested in the corporation to grow my business, as well as I bought real estate. When I'm buying real estate, I do a few different things. One is I have to make sure that the real estate is cash flowing. What that means is if the rent covers the mortgage and all of the expenses associated with that property. If that's a check mark, then I look to purchase that property. What you have to really consider too is how much money you're putting down. Are you putting 10% down, 20%, 30% down? Opportunity cost is big here. If you put 20% down, let's say the property's worth $1 million and you put $200,000 down, well, that $200,000 invested in your business, invested in stock, or invested in real estate, what's your return on investment? Your return on investment in stocks is between 6 and 8% conservatively. In real estate, it could be 10, 12, 14% depending on your neighborhood. And in regards to your business, it could be 100, 200, 300% growth, depending on how fast you're growing your business. So you got to weigh all the different options. And that's what I've done for the last 10 years. Stocks, you really put it there and it's a long-term set it, forget it. Real estate with rental properties, it's an investment, but you still got to do work for it. So there's an opportunity cost of yourself and your labor and your time allocated to those properties, but it's still, in my mind, a very safe investment. And you got to make sure that the property is cash flowing. If you put 20% down, you want it to cash flow. If you put 30% down, you want it to cash flow. If you put 5% down, you want it to cash flow. Cash flow is the most important thing with real estate because you want those renters to pay for the mortgage and pay for all the expenses with an extra little bit left for you for a rainy day for capital expenditures. What a capital expenditure is if a roof needs to be done, if a furnace needs to be done. These are all things that you need to do while maintaining a property that when you're looking at building your portfolio, you want to make sure there's a little bit of a reserve. You don't want to be pulling from your business or personal to fund that rental property. So the first thing I did was made sure that the property was cash flowing. 2, I set up a separate corporation. So I had an operating company running my business, and then every property I set up a separate corporation. Why? Number one, there's a lot of accounting fees and legal fees that go into it. So if you don't want to do one property per corporation, that's completely fine. You can do 1, 2, 3 properties, but I would separate your operating company from your rental property. So I would not put that rental property in your business from a liability perspective. If someone sues your business, they can also, whatever in that business or corporation, they can actually get, they can sue that as well. So if you have a property in there, they can sue that property and they can get the asset of that property. So you want to separate that property. 1, from a liability perspective. 2, from a bookkeeping perspective. I set up an accounting file for each property so I know the total income and all the expenses associated with that property. So come time for taxes, I have the income statement and the balance sheet all ready to go. And on a month-to-month basis, I know this property is generating this rent. These are the expenses, and this is what the interest rate is or the mortgage, so that I can keep my hand on the pulse for that property. If there's multiple properties in that corporation, the accounting and bookkeeping get convoluted because you have to allocate the rent to each property and it gets confusing. So if you are fortunate to separate each rental property with its corporation, with a different corporation, it helps a lot from an accounting and a bookkeeping perspective and a numbers perspective. You know where you stand on an ongoing basis. And this paid dividends for me because my operating company had an extra $100,000. I took that $100,000, I put it to a property. That property, that holding company then purchased the property. So that property now resides in that corporation. And then I set up a bookkeeping and accounting file associated with that corporation. So on an ongoing basis, every month, I know what's going on with that property. I could refinance it. And even from a banking perspective, if I'm looking for a mortgage or to refinance or to know where I stand from a mortgage and a cost perspective, if the bank ever asks any questions, I send them the financials right away because it's all organized. There's more steps to doing it this way, but it keeps you so organized so that when you do scale, you already have the systems in place to scale. So once you have the extra cash flow from your business, you put it into your holding company, that holding company buys the property, that one property goes to that holding company. Now you want to buy another property. You set up another holding company. That holding company is just a federal corporation in Canada. It's a 1, 2, 3, 4, 5, 6 Canada Inc. You can incorporate through Corporations Canada. Every year you would have to do a $12 annual fee and then your corporate taxes. But there's a lot of tax advantages and liability purposes setting up through a corporation through you personally. So that's exactly what I did for over 10 years. My operating company made extra cash flow. What do I do with that money? I open up another corporation, buy the property within the corporation, set up a different bookkeeping and accounting file per each corporation so I know where my number's at, and then it's very scalable. So now I want to buy another property, I open up another holding company, another holding company, and another holding company. So I have X amount of holding companies for each property, and every month I get financials to say, this property made, this was the rent, here are the expenses, and this is what the net income is, and this is what I'm taxed at. Now, the difference between a passive corporation and an operating corporation, if you're a small business owner and you make less than 12% in an operating company, you make less than $500,000, you're taxed at 12% because you're operating that company, you're hiring employees, you're doing everything to kind of stimulate the economy. In a passive corporation, let's say your rent is $10,000. Let's say all your expenses for simple math is $10,000. So your net profit is $10,000. Well, in Canada, your passive income would be, you'd be taxed at a passive rate, which is 50%. So $5,000 goes to the government. Now you can depreciate your property. There's other things you can do. But it is taxed differently than your operating company, which you have to be aware of. So that's another thing. I'm looking at every month, all the different income and expenses that come in. I see what my net profit is. If it's higher that year, I might want to redo the roof or buy fridge or buy appliances, buy things that are needed for that property to lower my taxable income and build up my asset in my corporation. So I wouldn't have that visibility if all my rental properties were under one checking account and one savings account and everything flowed in one account. I would never have the full visibility to make the right decisions at the right time, because at the end of the year, it would be too late to get a new roof done or get new doors done or do stuff to improve the property because you just don't know what your tax liability is. So having your financials done every month gives you as the business owner the ability to see where you're at and, more importantly, be able to scale with it. So when you start buying multiple properties, you put up more holding companies and you can scale that way. That was my playbook that I did for 10 years. It worked tremendously for me, and it could work for you too. If you don't want to go through all setting up the corporations per each property, what I recommend you do, every property has a different checking account. So checking account 1, checking account 2, checking account 3. Each property, the interest and mortgage goes out of that and all the expenses. And then if you need a credit card, I would stick with e-transfers or just debit payments so that you don't get 3 different credit cards and have all those different fees. You have 3 checking accounts and all your income and all your expenses go through that. It is a cheaper way to do it, but you have to be really disciplined to not leverage both checking accounts. Like if you receive a check, you have to make sure you deposit it in the right checking account for that property, because if it gets convoluted, then you won't know your numbers. The biggest thing for my playbook to help me was I always knew my numbers. I always had that scorecard. I always had that full visibility to know exactly where I stand in my business. And I treated my rental property portfolio as a business. Set it up on an accounting file, set up the financials, get the numbers, and analyze it, because you never know, hey, why? And a perfect example was one of my rental properties. The toilet, the water was flowing, and the bill went from $100 to $500. I was able to catch it that month because I saw the different variants of one month to another month. And I was like, okay, something's wrong with this property. The tenant didn't tell me. I sent in a plumber. We fixed the toilet, and the bill went back to normal the month after. If all those expenses were under one account, I would have never had visibility of that specific property and that specific problem. The tenant didn't tell me, and there's no way I would be able to find out because it was a simple little fix. So my recommendation to anyone that's building this type of portfolio is definitely leverage your corporation, take that money, build holding companies, and then scale that way. Even having 1 or 2 rental properties in a corporation, that's an option too if you don't want to set up a rental property per each corporation. But it does help from a visibility perspective. Why, instead of buying it, why not use your personal money to buy the properties is because, let's say in a corporation you're taxed at 12%. That's $88,000 that you have an extra cash flow from a corporation to another corporation. If you made $100,000 personally, that's a variable tax rate up to 54%. Let's say 35% at $100,000. So you're taxed way higher personally to take that extra cash flow and use it as a down payment to a property. So why you leverage the corporation is because you're taxed less in Canada as a small business owner. So setting up a corporation using that extra cash to buy property is way more advantageous than pulling out a salary out of your corporation and using that net flow cash to then buy properties. You're taxed higher, so you have less money for the down payment. I hope this helps. If you have any questions, I'm here for you. I run in an accounting company called Taxify, which this is all we do. We make sure that you're compliant with CRA. We give you your time back and you know your real-time numbers. So you can connect with me at the link below.